How should you allocate your TSP in volatile stock markets? I'm JT, and this is all about FIRS. It's no secret that this year, 2024, is an election year, and historically, election years have brought lots of volatility in the stock market. So, what can we do in the TSP to protect our investment and plan for the future? We have a simple investment rule that says any money we need to spend in the next 5 years doesn't belong in the stock market. So we can kind of look at our different expenses. If we're saving up for a down payment on the house, if we have medical expenses coming up, we're saving for a big trip or a car payment, and we have a lump sum of money, we're going to spend that within the next 5 years. It doesn't belong in the stock market. We should go into savings accounts, CDs, maybe money market. And right now, those are paying better interest than they used to. So using that 5-year rule is kind of a lens of should we be in the stock market or is this short-term money? Any short-term money should not be in the stock market. So on the other side of that rule, any money that we don't need to spend in the next 5 years should be invested in the markets where it can get maximum growth. Why do we say 5 years? Well, we think back to 2008, and it was 2008, 9, 10, 11, and 12. In 2008, the stock market fell in half, and it took 5 years to get back to break even. That was the worst 5 years that we've seen in the markets. Normally, recessions are 2 to 3 years, but 2008 being the worst was 5 years. So we're pretty confident that if we have 5 years worth of living expenses or account distributions set aside on the sidelines, then we can be patient with the market volatility as it goes up and down. So kind of using that 5-year rule as a guideline, we can build out an investment strategy inside the TSP or in an IRA. So everyone's needs are different, and the way that we build out a portfolio is going to be different for everyone. But just as a general guideline, let's talk through a strategy or the process that we would go through. We like a bucket strategy. So let me draw out here. We'll just imagine your entire portfolio all together. This would include all of your accounts. This would be IRAs, TSPs, anything from previous employers if you have 401ks. But imagine your entire portfolio. We would divide into 3 separate buckets. The first bucket is cash. We want to have 1 to 2 years worth of distributions set aside in cash, ready in case that we need it. We want to have it outside of the markets to keep it safe and secure. So if we need $1,000 a month in income from our investments, then we have anywhere from $12,000 to $24,000 of our portfolio just in cash. The next bucket is income. This is where we want to have 2 to 3 years worth of distributions, again, set aside from market volatility, but this is where we want something a little bit better than cash in terms of growth. So this would be money market, short-term bond funds, maybe CDs. This could also include the G fund in the TSP, something that's going to earn a good interest rate, but it's still safe from market volatility. So between these 2 buckets here, we have anywhere from 3 to 5 years worth of those distributions set aside from market volatility. So that helps us be really patient with the markets as they go up and down. Because if the markets come down, then we can draw from cash to help bridge that gap until the markets come back up. So that last bucket is growth. And this is, again, 5 years plus money. Any money that we need to spend in the next 5 years, it doesn't belong in the markets. But any money that we're not going to spend in the next 5 years, in other words, any long-term money should be invested in the markets where it can get maximum growth. So we expect volatility in this bucket. We expect it to go up and down, but over the long term, we expect to see good growth in that bucket. And as we see that growth, we can use that to replenish the cash and income buckets so that if we're taking distributions, we can continue to take that money from the cash allocation. So this strategy enables us to be a little bit more patient with the markets as they go up and down. So there's a few ways to implement this strategy in the TSP. The L funds can do an okay job of implementing this. You'll need to look at those allocations and see which year kind of lines up with your cash flow needs. Otherwise, a balance between the G fund, the F fund, CS and I, and just picking those funds yourself could be a good option. If we transfer it to an IRA, we have a little bit more control over what those allocations look like and how we can draw income. So if you'd like to discuss your unique situation and how you might allocate your TSP, click the link below to go to our website to schedule a consultation with one of our federal benefit specialists. Until next time, happy planning.